Right, good morning. Half an hour away from the opening bell here in Hong Kong, in Shanghai and in Shenzhen. Welcome. You're watching The China Show. I'm David Ingles with Yvonne.
Our top stories this morning. Asian stocks are gaining, led by Japan's post-holiday bounce. Traders betting that a Fed rate cut this year is still on the cards. And we got the RBA looking set for a hawkish hold when it makes its policy decision later on.
Also ahead, President Xi Jinping meets Emmanuel Macron in Paris, calling on his French counterpart to help fend off a new Cold War.
And China's property and consumer sectors in focus, with tech hub Shenzhen easing home buying rules and Labor Day holiday tourists keeping a tight grip on their wallets. All right, we'll get to all the holiday data and the like in just a minute, but you take a look at what the risk action and risk appetite here this morning. You are seeing a slight bit across equities here. In fact, we're actually still hovering on those two-year highs when it comes to Asia-Pacific stocks here, and we are on track, I think, about 1.5% away from hitting the highs that we saw in 2023 as well. So certainly one to watch here today. You take a look at how Nikkei is doing, with Japan really driving that charge here today. Coming back from that holiday strong, it seems. We're up about 1% in Tokyo. Big earnings coming up this week, the likes of Toyota, Tokyo Electron, so key to watch here. Nintendo also reports a little bit later on today. Kospi is doing a fiery bid here. We're seeing close to 2% gains. Taiwan just coming online, also doing quite well as well. So certainly the appetite for equities is still there relative to what we're seeing across bonds here this morning. Really steady when it comes to the Treasury market here. We did hear from some Fed speakers overnight. Didn't really move the needle too much. The RBA could be potentially next because they are set to hold, but there is one in the loan group there that maybe thinks a rate hike could be in the picture here today. I believe it's Capital Economics, just given how inflation has picked up. And are we going to see the RBA lean a little bit more hawkish here? You're seeing the Aussie hold its gains of late here. We're at 66 cents. Aussie yields not doing a whole lot here. Pretty steady leading up to that decision in just about an hour or two. We're watching also dollar yen. So we did hear some comments from Kanda-san here saying that, look, the government need not intervene if markets are orderly. Is that sort of a test for some of these traders here to really kind of, I don't know, bring this trade a little bit higher again? I'm not sure, but you're still seeing that strength. We're hovering around that 153, 154 level here right now. We're also watching Brent markets and crude in general. So it looks like these truce talks in the Middle East have basically faltered. And so we are seeing a little bit of risk premium coming back into these oil markets. Iron ore, that one continues to be a strong trade, despite seeing a bit of weakness here today in Singapore, where basically we briefly touched around 120. And then also Dalian futures are watching very closely as well. I think we've reached pretty much the 20% gain since the April lows of late. As didn't do a whole lot. Maybe we're just tracking some of the gains that we saw in Hong Kong yesterday, just given really the momentum and the buying was back on the onshore markets. We'll see if we see a second day of this. But right now, futures are heading a little bit lower here this morning. We talked about some of those travel data. So, yeah, spending was up. The number of bookings and travel was also up. But SocGen had an interesting note, Dave. You break it down to per visitor spending, still not quite to those 2019 levels just yet.
Yeah, I think people are too busy taking pictures than spending, which is really, that sounds like banter, of course, which it partly is, but it certainly just underscores the changing of habits and this longing for experience more than that extra handbag, if you will. We're up 10 straight days now on Hang Seng Index. Could do day 11. We'll see what happens with that. Foreign exchange reserves data comes out today, both Hong Kong and China. We'll talk more about the third bit in a moment there. So turnover actually in the mainland actually topped 1 trillion renminbi for a fourth straight day. Might that be an indication of increased participation in this market? Yvonne talked about where we are in iron ore prices. EVs have done exceptionally well amidst these last 10 days or so. We're watching that. And, of course, all things that come through out of the President Xi Jinping's trip, of course, over in Europe. Dalian, bottom of your screens, $900 there. First time, I believe, going back to early Feb. Yep, let's talk all things markets.
Yep, especially when it comes to China, when you take a look at, really what's behind this rally, and we're going to talk to Shuli Ren, our Bloomberg opinion columnist as well, about this fierce rotation that we're seeing. Let's bring Lilian Leung, China Income Fund Portfolio Manager at JPMorgan Asset Management. How real do you think this bull market is right now?
Well, I think sentiment definitely has improved because I think investors getting slightly more confidence about the policy direction, especially on property market. Because I think in the past, people were still very skeptical about, whether the policy will be effective. And now we've got a little bit clearer kind of picture about the overall policy direction, and with I would say, stronger hope that some of the ultimate problem can be solved. Not sure within like 1 to 2 months, but then the direction is actually on the right path. So I think that's the key change over the last month or so, when investors start to feel like we finally get to the right direction to solve the problem, in particular for the property market. So I think that's the key kind of turning point.
You're right. There is a lot more clarity beyond the short term that investors see. We'll talk more about income strategies in a moment, but just generally speaking, to take us into that, do you think this rally is supported by earnings and what we've seen so far? Because at some point, investors will also start to look for a fundamental story here.
Well, I think ultimately, as you said, you have to be supported by the earnings revision. We haven't seen that across the board, but actually within certain sector, earnings has been actually very resilient. I mean, it's just that we have been suffering lots of derating. A little bit, you can argue part of it is like non-fundamental related. And now we are basically reversing that kind of trend. Right. And next step up will need to be supported by earnings revision. And then when we're going to see that, it will depend on how effective the policy is going to stabilize the fundamental of the economy. I think that's the key.
What are some of the sectors that you think are a little bit more resilient, given this earnings season we've seen so far?
Oh, well, definitely the upstream, like the energy, some of the leaders, even within the consumer discretionary sectors, they have been holding up, very well, in particular on the cost efficiency side. Even though revenue may not be that kind of super, but their operation efficiency improvement have basically kept the margins on the upward trend and beat kind of market expectation. Yeah.
Right, and that takes us straight into, dividends, margins and dividends. And from an income perspective, does it make more? Are you getting the proper dividend yield right now?
Yes.
Because in the bond market, there doesn't seem to be anything there.
Well, I think one thing we have been arguing is that we are actually seeing our income or dividend kind of source coming from a wider spectrum of sectors. I think in the past it's mostly from like banks, some of the utilities. It's still the core part of the kind of yield sources, but now we are able to diversify, to like consumer electronics, information technology, industrial, a wider spectrum of industrial space. I think there's actually this kind of change has been very supportive to drive the overall, not only positive to China income strategy, but I think it will be a key pillar to support the sustainability of the rating of the overall China market, because improving shareholders' return, a more stable kind of total return profile should be like one of the key support to the drive the recovery rating. Yeah.
Yeah, we were just talking yesterday with our strategists about that equity risk premium that China has, which might be better than most markets in Asia here right now. So does that mean that you're tilting more to the equity side versus the stock side, the CGBs right now? I should say bond side?
Yes, we have been taking our equity to over position like 2-3 months ago on the relative, like more attractive relative valuation versus like fixed income, and we are still overweighting the equity at the moment because, as mentioned, either we are potentially seeing potential earnings revision upgrade, and also from a shareholders kind of return perspective, we are seeing lots of companies improving their shareholders return, which basically will be supportive to our overall China income strategy. Yeah.
Right, and what changes have you seen in the CGB space that have made you overweight or push yourselves overweight to equity markets? And I'm getting to one of the other stories which hasn't really gotten a lot of attention, this pushback from officials in the CGB market that maybe things are getting more divorced from fundamentals.
Well, I think it's more about relative valuation attractiveness, because like for equities, we are seeing the potential upside not only from like the earnings revision, but also the way they provide the shareholders return, because there's still lots of companies that are able to increase dividend payout and make it more sustainable, kind of pay out more explicit kind of dividend payout policy, which basically will help investors to navigate the potential total return profile for investing in China's equity. Versus in the past, we only bet on like valuation kind of changes. Right now, we are able to see potentially more long-term investors can basically navigate your expected return much better or less volatile way.
We've seen in this rebound what's really been driving it is, well, you mentioned property. Tech is certainly one factor as well. I mean, are you looking into more the growth sector here right now as well?
Yes, I think in particular after kind of like share price kind of collapse in the last 6 to 9 months ago, we are seeing a lot more IT names with more, I would say, attractive valuation right now. So in particular the hardware tech. They're more exposed. Potentially, they're also part of the beneficiary of the AI kind of boom, and valuation is still quite attractive from our perspective. So we are basically taking more, I would say, position into this space.
What are you seeing in terms of just what strategies are more in favor now? Because you run income strategies, for example, and increasingly you are being able to add tech into your portfolio. And I'm wondering, with the rally recently, there's chatter in the market that people are buying index funds. It's the best companies, it's the growth companies. And I'm wondering, do you think that comes at the expense of income strategies, given the current nature of this rally?
I think we've seen a bit more balanced kind of flow recently, and I would say the income strategy, I think one of the core advantages is that because we have like mixed asset kind of asset class, we through asset allocation and also our stock picking, which supposedly would be less volatile than the overall market. So basically our, I would say, return profile will be less volatile than the over just buying into like equity index fund. So it really depends on what kind of investor who might some investor who might not want to bear the kind of high volatility within the pure equity market. Then it would be this kind of like the strategy that we'll go for.
Yeah, we all need less drama in our lives, right? There we go. Lilian, thank you so much. Less drama, more income. A portfolio manager, China Income Fund at JPMorgan Asset Management. Right. Just ahead here in shows, we'll get you guys up to date here on the president's trip in Europe as trade and security talks, of course, persist and progress there with the French president and also the EU chief. Details of those discussions coming up next.
Yeah, we're also counting on the opens of trade in Shanghai, Shenzhen, and Hong Kong. It looks like futures are pointing slightly to the negative side of things. We're down about 0.5%. This is the China Show. Happy Tuesday.
We discussed how to make real progress on market access. I remain confident that more progress can be achieved. At the same time, we stand ready to make full use of our trade defense instruments if this is necessary.
And that was the European Commission President Ursula von der Leyen speaking during Chinese President Xi Jinping's visit to Paris. For more on the trip, let's bring in Stephen Engel, our Chief North Asia correspondent. There's trade tensions between the two, and how did the Chinese president address that?
Well, obviously, he's trying to fend off some of the consensus that is building across the Atlantic with the United States, issues about overcapacity. We had Olaf Scholz, the German chancellor, go to Beijing a few weeks ago and also brought up those issues of overcapacity. And again, these are the issues that are key to domestic politics as well in Europe. I mean, autos is Germany's biggest export product, right? So they feel under threat by EVs, in the overcapacity of EVs and allegations, at least, of subsidies to these companies and dumping allegations as well. So again, there's mounting differences between China and EU, not only over Ukraine, which I'll talk about in just a minute, but these trade issues. Trade has become a major issue, obviously, and we've heard it just there from the EC president, Ursula von der Leyen. And again, there's a tightrope being walked with Macron as well as with the other EU leaders on this trip with Xi Jinping. And this is what Macron, I think we have a full screen quote of what he had to say. He said, "Nobody dictates our trade, economic and technology policy. We wish it to be a sovereign, which means independent." So again, there's that fine line that these European leaders have to walk. There is a rising chorus about issues of subsidies to these Chinese exporters of green products, which we've been talking about quite a bit. But at the same time, people like Emmanuel Macron and other European leaders still want to do business with the Chinese. So that's that fine line that they have to walk, and not necessarily. And this is what Xi Jinping wants to make sure on this trip. And it's a very calculated trip to these three countries, Paris, or France, obviously, Serbia, and then Hungary. They're not going to necessarily get a parroting of the U.S. views on trade as well as perhaps Ukraine.
And it seems like trade, there's maybe a bit more leeway on Russia's war in Ukraine. That's where you're starting to see more, I guess, of a divide.
Yeah, and the people that were in this trilateral meeting between Xi Jinping, Macron, and Ursula von der Leyen say that Xi Jinping sort of bristled when some of these not necessarily allegations, but assumptions that perhaps the relationship between Beijing and Moscow has aided the war in Ukraine. You know, the whole issue about dual-use products that end up potentially on the battlefield. So this is something that the European leaders have brought up. Ursula von der Leyen essentially bringing this up not only in the matter of trade, but on the issue of security threats to the European Union. This is what Xi Jinping had to say about that. First of all, he said Beijing is not the origin of this crisis, meaning Ukraine, nor a party to it, nor a participant. He says we oppose this crisis being used to place responsibility on a third country, obviously he's referring to China, and tarnish its image and invite a new Cold War. And that, I would say, is probably Xi Jinping's biggest aim of this trip to Europe, his first to Europe in 5 years, and that is to make sure and to fend off the concern that America's geopolitical stance, and also on the trade front on overcapacity, is not necessarily cemented in the EU.
All right, Steve, thank you for that update there. Our Bloomberg's chief North Asia correspondent, Stephen Ingles. We're taking a look at that fix here this morning, and it looks like we're back above that 710 handle for today. So right now we're seeing a 721.75 when it comes to your offshore rate as well. We definitely saw that catch up from the onshore markets yesterday coming back from that holiday. But there you go, 710.02 for today.
Right. Yep. A little bit of dollar strength, in fact, coming through in the last 6 hours or so. That takes us into futures going into the open 10 minutes away, give or take. And we're looking at futures doing this. 10-year CGB's at 230 right now. Do we get a day 2 on the mainland? Do we get a day 11 here in Hong Kong? We'll find out in a couple of minutes. A preview, the trading day ahead. In a couple of minutes, this is Bloomberg. Right, going into the Hong Kong and mainland China Open. Hong Kong looking slightly underwhelming, maybe more unconvinced. We'll see. It's early. We'll see what happens here, of course. In terms of data today, we're getting the reserves numbers coming through, but apart from that, we're looking at all things markets given this rally, and we'll see if that pauses today, that's been taking place over the last, 10 weeks or so.
Yep, here are some stories that we're tracking for you today. Citigroup has shifted the work hours of some of its staff in Kuala Lumpur to align with those in the U.S. The move is part of efforts to ensure a smooth transition to a one-day settlement cycle. Citi has also created a task force that will solely focus on the process, also known as T+1, and it joins dozens of other financial institutions preparing for the shift that comes into effect on May 28th. Nomura is targeting 20% revenue gains for its global markets unit over the next few years. The unit's head told Bloomberg they expect 25 to 30% growth in macro credit products with equities, with the rest coming from wealth management. The business has returned to profit after 3 years of losses that included a $3 billion hit from the Archegos scandal. Lucid shares fell sharply in extended trading after the EV maker reported a worse-than-expected result in the first quarter. Its adjusted loss of 30 cents a share was worse than analyst expectations for a 25-cent loss. The company is contending with production challenges and uneven demand for high-end EVs. Palantir shares also falling after hours as its annual sales forecast failed to impress. The AI software and analysis firm nudged its revenue forecast slightly higher and raised its outlook for adjusted operating income to over $868 million. Palantir has been one of the outstanding stocks amid this current AI frenzy.
Right. Going into the open today, the Tuesday open, so we're looking at some weakness, trading sideways here across these markets in Hong Kong. In fact, yesterday, for the better part of the session, things did look iffy, and then we just managed to close higher for the day. So that's day number 10, doubtful. We'll see what if we get a day 11. UBP out with the notes. I think it was out late yesterday talking about how the rally not yet backed up by earnings expectations. And certainly when you look at 12-month projections on MSCI China, just to be more specific, we're still seeing that somewhat rolling, I want to say rolling over, but it hasn't reversed higher on an index level just yet. Right, PBOC draining some money out of the markets today, 440 billion in renminbi open market operations. It takes us into the money story. The chart you're looking at is turnover measured in renminbi. On the mainland, obviously, we're looking at 5 years there. That yellow line is at 1 trillion mark. So yesterday, a fourth straight session of about $1 trillion turnover onshore. That's a daily amount. Now, the reason this is important is because this has been a feature, maybe insufficient, but adequate, or necessary at least feature in previous rallies. So we've seen this spike above 1 trillion back in 2020, 2021, 2022, and of course back in Feb. So a good indication of sentiment here.
Yeah, and you got to wonder, I mean, after north of 20% gains on MSCI China, what's next? Is this really something that is sustainable? Does it spark a re-rating, or are we still just talking about tactical rebounds here right now? Yeah, well, the fundamental stories have yet to really come together, right, as far as that. In fact, on that very note, almost the news gods are dropping this. On the property story, S&P, talking about how the property market is still searching for a bottom. So I'm looking at this press release that's just dropping in our inboxes right now. And in fact, we'll talk more about the property story in a couple of minutes. We got those new home sales, right? Didn't look good either.
No,
in
not
big cities.
39% drop in April.
Yep. Analyst actions. We're watching a little bit more in the renewable energy space. So Longy Green cut to add at CITIC Securities. CGN Mining also rated new outperform by Haitong International. Morgan Stanley had an interesting note when it comes to these liquor makers as well. So raising its price targets for two of them, so Wuliangye and Luzhou Laojiu. They're factoring in what we saw in the earnings for 2023 and, of course, the first quarter results as well, and what they're seeing in volume growth. So the price target for Wuliangye raised to 182. Still maintain that overweight, but certainly that could maybe continue with this bull case when it comes to these liquor makers here today. The pre-market is looking like this here right now, so property continues to catch this bid here today. We're watching very closely some of these names. SIFI Holdings is up 1.5% or so far. Travel stocks as well. You dig under the hood. I mean, the numbers were strong, right? Travelers made 28% more trips. Spending only rose about 13.5% from 2019 levels. But maybe per capita spending still not quite there yet. So we're watching very closely. But Tripp was talking a lot about the data about outbound and inbound travel was pretty strong this holiday.
Yep, and their shares, they're record highs, I believe, on Tripp.com. Going into the open today, 3 minutes away, you're watching the China Show. Good morning.
Welcome back. You're watching the China Show. We're counting down the open of markets. The CSI 300 was able to rise to those October highs yesterday, coming back from that holiday. It looks like right now momentum stalling a little bit, especially what we're seeing in these Hong Kong markets after the stellar 20% more gains as well that we've seen in offshore markets. So we're unchanged in the Hang Seng here right now, a 721 handle. So some weakness coming through back into the Chinese currency here this morning. And Dave, really, we're still tracking what's been going on, everything from property data, from the travel data, still maybe showing some signs of weakness still.
Yeah, we're getting a lot of pockets of information coming through, which we'll try and put together. So, on the property side of things, and there's still the Shenzhen story, which we haven't really gotten into a lot, and them relaxing some rules in certain parts of Shenzhen. And also when you look at some of the monthly revenue and sales numbers from developers, certainly not, well, I guess in many ways underscoring the point out of S&P just earlier on, that the property market has yet to find a bottom in China. More on that in a moment. Your open's looking flat right now after really coming back strong from the holidays right now. A glance at some of your big movers and the biggest stocks onshore right now. Flip the boards, please. Let's have a look. And by the way, while we're flipping the boards, iron ore, just to mention that too. We're trading closer to 900 now for the first time since early Feb. Weakness coming through in Hong Kong. I guess just to give you an indication of how far this rally's come. Onshore, CSI or Shanghai Composite, it's about 15% from the bottom. This is about 20%, this is about 30%, this is about 25% from the low. So we've actually come quite a bit. Let's take a look at property, Hang Seng property very, very closely. Look at that, and of course some of the other benchmarks on the property counters. CSI 300 Real Estate Index, Shanghai Prop, China Real Estate, our BI gauge, of course, on the back of news that Shenzhen is actually loosening some of these restrictions. Now, what is the underlying reality here? A couple of things that we mentioned, right? So we're putting some data together. New home sales, this is based on data out of Wind and also Macquarie, and they put that in that specific report. So what we're looking at here is you're looking at 3 years, right? 2024, 2023, and 2019. And effectively, as you can see, we're at the moment, as of April and May, we're actually below trend. So year on year, still looking at declines here on sales of the 30 largest cities. Right, now what are we seeing in the biggest of the biggest, right? Beijing, Shanghai, Guangzhou, and Shenzhen, your tier 1 cities. We're looking at weekly numbers, and based on the weekly numbers, it's still showing some weakness coming through year on year. We have the terminal chart. I think we can get that up for viewers to see that. And yeah, here we go. There we go. This is yearly 2017. You do see the trend lower. So we're looking at weekly numbers, 232. You compare that to the same week last year. All 4 major cities, Yvonne, are still seeing declines, with the biggest declines in Shanghai, the least declines out of Beijing. Yvonne.
Yeah, maybe why we're seeing some more home relaxation,
necessary.
Home buying relaxation, I should say, in some of these tier 1 cities. S&P, we just talked about that note that came through here, talking about, look, this property market is still searching for a bottom. We're getting a little bit more details about this. They're saying a double squeeze looms for China's property market. Structural factors, which Dave has been talking about, are still squeezing rated developers, strains that are unfolding alongside a continued sale slide. That's after what we heard from Shenzhen, right? So the tech hub in China joining other major cities in easing home buying rules as authorities try to revive this real estate market. For more, let's bring in our Bloomberg Intelligence China property analyst, Christy Hung. So first it was Beijing last week, Shenzhen now. How significant are these measures now?
Right, so we're expecting Shanghai could be next to relax its home purchase restrictions in the suburbs after you mentioned Beijing and Shenzhen. And then we're also expecting in the near term all T2 cities in China could remove their home purchase restrictions altogether. But as we have said here before, it doesn't matter how much easier the government's making it for people to buy a home, that won't overcome a lack of confidence. And if that's a lack of confidence on home prices, if people are not expecting home price to rise, investments are not coming in. And there's also a lack of confidence about their job. A survey in March is showing that 57% of white-collar workers in China are worried about losing their jobs in 2024. 57%.
Wow.
So, these are telling you how, sentiment's really weak on the ground. And also, if people are buying home, considering to buy a home at the moment, they would very likely think about second-hand homes instead of going for developers' pre-sales.
Yeah, because they can see that the building exists already, right?
It's built already.
What do the dynamics tell you then between the prices we're seeing in the secondary market, and how does that then educate us in terms of where we go with the primary market? You've done some research on this.
Yeah, so based on official data from NBS, we're seeing, since the peak, there's been a 10% decline in home prices in the secondary market versus a 3% decline in new homes. Well, we think that, reality we're seeing from projects on the ground, we're seeing steeper declines than the official data. But that's nonetheless telling you that, in the secondary market, homeowners, they have bigger flexibility to cut prices. And that is really where the true pictures is showing. But whereas in the new home market, because prices are heavily regulated by the local governments, some cities have before, stopped developers from taking too steep a price cut. So that is not showing you the true picture, and that's also hampering developers' ability to slash prices to boost their sell-through, to boost and shore up the liquidity.
The Politburo meetings, people seem to think that was maybe a turning point, that maybe policymakers are finally in the right direction in tackling the supply issues and really trying to potentially reduce inventories from these developers. Do you see it that way?
I think the concerns we have right now is there's a lot of secondary supply in the market. We have the housing boom in 2016 to 2020. A lot of people bought new homes, but with home price expectation changing, they're looking for the exit. They're offloading their new homes that they bought into the secondary market. In Chengdu, Chongqing, you're talking about over 200,000 units listed in the market at the moment for each city. That's also the case for Shanghai. You know, that's an ocean of new homes coming in, and on top of that, there's new home inventory from developers. So, you know, and at the same time, demand is dwindling. You know, how do we handle that? And that structural imbalances is the very reason why we're still very conservative on the sector.
Christy, thank you. Christy Hung there, our Bloomberg Intelligence China property analyst for us this morning. And from the property to the consumer sector, we've got travel data, so we talked a little bit more about this. Finally, we got some official numbers from the Culture and Tourism Ministry for what we saw in that 5-day Labor Day holiday. And it sort of paints a mixed picture, right? Trips were up 28%. Spending was up 13.5% from 2019 levels. Outbound trips and inbound trips both saw about 1.9, 1.8 million. So you're seeing not just outbound, but also inbound travel as well. They didn't give us last year's figures for those two, mind you. But also, you know, you got some from, you know, data from Trip, some of these agencies talking about, look, people are just opting for maybe cheaper places, maybe not so much tier one, also just going for maybe just best value for money sort of trips as well. SocGen did more of the crunching of the numbers. The concern is that per visitor spending is still below 2019 levels, which means in general people are only keen on traveling, but not so much on spending money.
Yeah, well, let's get a better sense of how this affects so that's the macro. How does this affect the micro at a corporate level? We're joined right now by Angela Han Lee, of course. She's with Bloomberg Intelligence, our senior APAC gaming and hospitality analyst. Today joining us, she's been traveling herself out of Singapore. Angela, what do you think, and Yvonne laid out this sort of discrepancy in the data, right? More trips but less spending. What do you think is behind that phenomenon?
Yeah, we are seeing that people are spending money to go out from China. So the outbound tourism is very strong during the holiday season. I think the major improvement this year might be mainly because of the increase of flight frequencies. I guess you guys may have noticed that the minimum annual leave requirement in China is 5 days. It's actually very short. And even when I talk to people of my peers, they still only have 5 days after working more than 10 years. So I think that means that the holidays are very important for them to travel, and the flexibility to travel plan a long trip is very, very low. So for that reason, I think increasing flight frequencies has been a key factor why people actually decide to go out from China this year. Also, given that some currencies like Japanese yen is weaker, so they want to spend more money outside. But on the other hand, I think I agree that some sentiment is not good in China. That's why people might be willing to go to county level cities or say even villages to explore natural adventures, or maybe just going for a music festival by those young people.
Yeah, I mean, you only got 5 days. You got to make the most of it. The housing market, though, as we were just talking to Christy, Angela, is still weak. Does this imply that consumers will keep being cautious when it comes to spending?
Yeah, I think I have an idea that if people already bought the properties or flats, or maybe they are suffering because the rate is going up, and also even they cannot sell the properties. But if you talk about those people who have just started working, or even who are still at 20s, then they haven't bought the house yet. So maybe given that the price is that volatile, they might feel maybe I don't even have to buy the flat. And you also notice that the marriage rate and birth rate is going down. So they kind of feel maybe I just enjoy my solo life. In that case, I feel they might be willing to allocate more a budget on spending for themselves, experience-driven ones. That's why I think in China you are still seeing that the concert ticket price is going up, and people still travel to different places to go to join these concerts. So I think some discrepancies is that people who are having more than 30 years old might be suffering something from property issues, but less than that, maybe still have more willingness to spend. Just that they are not wealthy enough because they just started working.
Okay, so willing to spend a little bit more on the concert tickets, but not so much on buying and shopping. Angela, great stuff. Thank you so much. Angela Han Lee, our Bloomberg Intelligence senior APAC gaming and hospitality analyst, joining us out of Singapore this morning. We got plenty more ahead. This is Bloomberg.
Okay, so about 12 minutes into the session, and things have started to stir up Is that the right verb?
Grind?
Yeah.
A slow grind? Yeah.
But yeah, I mean, it's green, so we'll take it. We'll see how we end the day. But that said, this is day 11 too on the Hang Seng Index, right?
Yeah. Day 2 for CSI 300, at least for now. But yeah, we're getting closer to, at least we reached those year-to-date highs for the onshore market there. We're focusing on some of the geopolitics as well. Oil's catching a slight bit here this morning in the Asia session. Israel rejecting that ceasefire plan backed by Hamas, saying that it falls far short and as operations in Rafah will continue. Let's get the latest now from our Bloomberg reporter, Bill Ferries. Bill, how did these talks break down? What happened? And you know, from the Israeli side of things, what do you think fell short in this deal?
Well, you know, we've known for weeks, really, kind of the broad outlines of the deal that's being discussed. It would involve the release of potentially dozens of hostages by Hamas, perhaps hundreds of prisoners from Israeli jails. It would involve a 6-week ceasefire. That's been one of the common themes running through these talks. We don't know specifically what led to this latest breakdown. The New York Times, for instance, is reporting that there were minor changes to the Israeli-U.S. draft proposal. And the big holdup has largely been centered around whether this ceasefire would become more of a permanent end to the war. Israel has pushed back on that. They say their goals are still to go after the Hamas leadership and those thousands of Hamas militants they say are holed up in Rafah. They do not want a ceasefire to be seen as the end of the conflict. Hamas, on the other hand, is hoping they can wind this down and have Israeli troops out. So that seems to be where the disagreements remain. But where it leaves us now is really in a bit of a limbo. We don't know if they can have a breakthrough in the next few hours or if we're going to see some of the fighting drag on for weeks again.
Yeah, and Bill, so in the meantime, should the assumption be, and we know the U.S. has been opposed to this, I think France and China put out either a statement or it was reported earlier on out of Xinhua that both China and France also oppose this. Can we assume that the operation still continues there, of course, in Rafah?
I think so at this point. Israel warned residents of parts of Rafah to leave that area, head north to Khan Yunis and get out of the way because they were planning to do more bombardments. We've seen them strike some targets. We haven't seen the full ground invasion. But Israel says it plans to go forward with this, whether that's a negotiating tactic to try to get Hamas to back down at the last minute. We don't know, but they do have their troops ready, and they do say that going in is part of their objective.
Bill, thank you. Bill Ferries there, a Bloomberg reporter with the latest on what's going on in the Middle East here. Some other major stories that we're following from around the world. U.S. and Philippine Marines have conducted rare military drills on the Southeast Asian nation's northernmost inhabited island. Ibayat Island sits just about 160 kilometers south of Taiwan, and the inclusion of that is this year's drills highlights the role the Philippines could play in any potential China-U.S. conflict over Taiwan. The U.S. is adding a tank-destroying drone to an accelerated effort to prepare for a possible conflict with China. The Switchblade 600 is the first of a new wave of lower-cost autonomous weapons. The Pentagon is publicly acknowledging its funding through its Replicator program. The weapon is known for helping Ukraine push back on Russian advances. The Canadian government will now require people lobbying or acting on behalf of a foreign government to register that activity publicly. The move comes after allegations that China attempted to meddle in the last 2 Canadian elections. Other amendments will also make it easier to prosecute activity related to illegal foreign influence. We got plenty more. This is Bloomberg.
Right, welcome back. Shares of ANZ, there we go, bottom of your screens. So the conversation is a buyback and a profit miss. We're down over 1% or just under 1% over there in Sydney. The bank has also just announced, as we were just talking about here, the 2 billion Aussie dollar buyback after first half earnings missing estimates. Group CEO Shane Elliott told us where they are actually seeing pockets of strength in their businesses.
We came off a record 2023. And what really delivered here, you know, revenue was flat at a really, really strong level. Expenses well managed. And importantly, it really shone through, I think, the value of having a diversified portfolio. as you know, the Australian retail and small business banking market has been subdued. And we experienced that like our peers, but we had really strong offsetting performance in our institutional and international business. So I actually saw a lot of strength in the result, and I think we're very well positioned for the environment.
You're joining us on RBA Day, of course. After 4.25 points of hikes, how are you kind of seeing the mood when it comes to clients, customers, and the broader economy, and how that's impacting your business?
Yeah, sure. So clearly there is some stress on the economy. I mean, that's to be expected given the interest rate rises, cost of living pressures, etc. So the market is subdued, particularly here, in Australia and New Zealand. And we see that. And we see that with more customers struggling, although the number of customers struggling is still, from a historic point of view, relatively low. So we have these hardship programs like all the banks. So people who are finding it tough call up the bank and ask for hardship. The number of people in our hardship program is 0.3% of all our customers. Now, it's devastating for those 0.3%, but it's 0.3%. 79% of our customers in home loans are still ahead on their repayment, so have paid more than they are required to do, and 50% are ahead by more than 3 months. So there's a remarkable resilience still sitting in the economy, although things are subdued.
With competition pretty fierce within Australia, how vindicated are you by your international strategy? And I'm wondering if you can give us an update, given there were discussions with pension funds to bring into India, investment in the special economic zone, and also maybe an update on how procurement of licences is going in the Chinese market for ANZ.
Yeah, great. So, look, the point of difference for ANZ is we're the most diversified of the major banks in Australia. We have 4 great businesses: New Zealand, our retail business here in Australia, our small business banking here in Australia, and, of course, institutional. And probably the piece that we really shine in terms of our point of difference is institutional, which services some of the world's best companies, biggest companies around the region of Asia Pacific. And we operate in 29 markets around the world. And that business really came through very strongly. So now it's been hard work. You can't just turn up in Singapore or India or China and expect to get a fair go. You've got to work really hard. And we've worked really hard building a strong foundation with the right customers, knowing and investing in things that we think we do better than others, which is facilitating the movement of goods and capital around the region. So we're in all the right places we need to be. We've got all the licenses we need to have. And more importantly, we have the customers that we need.
That was the ANZ Group CEO Shane Elliott speaking to us just a short time ago. Of course, you can turn to your Bloomberg for more on this. TLive Go to get commentary and analysis from our expert editors. And, of course, we're tracking everything from the Milken Institute, the RBA decision coming up in just a few hours as well. Yeah, lots of events taking place concurrently. There we go. That's the word I was looking for. RBA is coming up. So we're looking at the Aussie dollar. And, by the way, so the level you're about to see on your screens is actually quite near this high we hit back in March, and certainly the assumption that any hawkish pivot or statement out of the RBA might actually push that beyond that peak. We also did get Philippine inflation earlier on towards the lower end of forecast at 3.8%, although the Banco Central came out with a statement too that the risks to the inflation outlook continue, in their view, to lean toward the upside. Right, that's a brief look at currency markets. And, of course, the Bank of England is, of course, on deck as well this week. Cable is doing 125.57. Chinese markets doing this. And we're now just coming off highs a little bit on the Hang Seng Index. CSI 300, though, is still seeing some upside right now. Yeah, and interesting enough, HS Tech is actually selling off a bit here today. Usually they're the bigger driver of profit-taking, maybe. Yeah, maybe there's a bit of profit-taking going on in the tech space here today. Coming up, really, in the next hour, watching very closely, we're going to talk with the Fed. A lot of Fed speak this week. I think it's nearly 12 speakers that have been going to be... 12? I think it was like 11 that are set to be talking this week alone. So T. Rowe Price's Thomas Poullaouec is going to be joining us why they continue to expect 2 rate cuts this year. So I think we've gone from whether we're going to get these rate cuts to when are we going to get them. I think that jobs report at least shifted the narrative just a little bit to maybe September? Back half of... Yeah, September, November, December. Well, 12 speakers. Yeah, that's one for every day of Christmas. And by the time we get to that, we might actually get a rate cut. So, we were talking about the Milken Summit earlier on, right? So Jenny Johnson, head of Franklin Templeton, actually said we probably get 1
but the probability of us getting 2 is a lot less than us actually getting no cuts at all.
Okay.
So 1 at best is what she had to say. And we'll see what the 12 say.
So, or 0 or 2, more than 2.
Yeah.
Yeah, that's interesting.
Yeah.
Okay. We'll see what happens, and we're going to digest some of the latest Fed speak as well. Williams, Barkin did speak overnight. We'll have a lot more on the way. In the next hour, you're watching the China show. Welcome back to the China show. Here's a look at the HSI, just a half hour into the session here, and looks like, we're back in negative territory here once more. But yes, we talked about, right, this rally has been gone for some time now. We were thinking it could get to an 11th day, but certainly things might be looking a little bit overstretched. You take a look at MSCI China, though, we're still slightly flat here right now, but we'll see how this all plays out. But CSI 300 at least, I think we're doing a little bit better there, Dave.
Yeah, I mean, this market, as you can see, is moving quicker than our, we can type headlines out. Bottom up here. It was actually a few seconds ago to defend ourselves. Of course, we were on track for an 11th day of gains. We'll see, right? So we've been bobbing between gains and losses. And to Yvonne's point, right, overextended, you're getting a lot of momentum coming through. I mean, 10 straight days, that's what that does, right? So, measures of momentum, good example before I talk about this, RSI, your Bollinger Bands do indicate maybe it might be time there to maybe take some of that froth off the table. More on that in a moment. Dollar yen, bottom of your screens. We're looking at, of course, some of the property names listed in Hong Kong. You're getting some news out of Shenzhen on them relaxing some of the property restrictions and home buying restrictions following what we got out of Beijing. And our analyst, Christy Hung, out of Bloomberg Intelligence, actually thinks Shanghai could be next. Right. Broader read across these markets right now. We're looking at Asia Pacific. Japan is coming back online today, shut Friday and Monday, and that's pushing the benchmark now at 0.25% to the highest level in about 2 years or so. So I guess this is really on a lot of things. You had the China story, and of course, Yvonne, you also have these hopes again are back that the Fed could cut at some point this year, maybe boosting what we're seeing as far as equity markets go.
Yeah, even if it's as far away as November, December, or even September, right? When we get very close to that U.S. election. Yeah. We did hear from some Fed speak overnight. The Bank of New York President John Williams saying that rate cuts will be based on the totality of the data. He did speak at a panel at the Milken Institute Global Conference in Beverly Hills.
For me, it's really looking at the totality of the data, not just looking at an employment report or a CPI or other piece of information. You really want to make sure we're looking at the broad picture. We have the maximum employment and price stability goal. So we want to, from my perspective, see all the data and information that speaks to all of that. And really, as the data, come in, hopefully we'll be moving in the direction we want to see, both on inflation and in terms of restoring balance to the economy. And then we'll make our decisions based on that.
We're joined here in sets. Thomas Poullaouec, head of multi-asset solutions for APAC at T. Rowe Price, normally based in Singapore, but we see him enough, of course, and quite regularly here in the city. I want to talk to you about the Chinese markets in a moment. That's been one of the main stories. But, why don't we start with the macro backdrop and the Fed? And can we still trade on the assumption that at some point this year, easing begins?
Look, if you look at the probability, what we see is that on average, it's about 1 to 2 rate cuts, but you have a wide range of probability around that. And even 20% of probability is still betting on a rate hike by the end of the year. So I think that's the kind of things that you need to take into account, is that you have an average, which is still pointing to some kind of easing by the end of the year. For us, our U.S. economist is still betting on 2 cuts for this year. But what we see is that there are still a wide range of assumptions. And as it was said just before, the data will be key. And we don't think that we will get perhaps enough data by the summer to get the first rate cut in July. So that can be postponed to the second half. And in that case, you might be left with only 1 cut for this year.
Okay. So, and the narrative seems to be last year was we're going to head into a recession. We still haven't seen that. Now it's more about inflation. How does that change the overall playbook for you, especially when it comes to multi-asset allocation?
So look, A little bit of inflation is not too bad for equity because equity earnings are in nominal terms, and you can see that, for example, in the US, the earnings growth for this quarter was about 6% compared to a low bar that was at about 3 or 3-ish%. So definitely earnings outpaced expectation, and part of the story is some of the price hikes that came at the beginning of the year. So there is a bit of inflation that can help equity, and we can see that the data is also in a signaling that, yes, the economic growth is still quite weak, but getting better. And we can see that PMI are moving higher. That's true in the US, that's true globally. When you look at global PMI, you can see that we are above 50 right now. So it's something that points to a reacceleration in the short term of the global economy, and that supports equity over bonds in our portfolio.
Where specifically in equity markets?
So the largest overweight that we have remains Japan. That's a long-term story around corporate governance, but of course the weak yen is also helping the export sector. After that, when you look at some pocket of Asia, you also see some strength, according to us, that will come from, for example, South Korea on the back of this uptick in global growth. So the export sector also can do well, but you have also the AI story that is really benefiting that market. And then if you are more adventurous in Asia, you have Vietnam. Vietnam is also 80% export driven. You have a very cheap market after some issues last year, and you have the possibility, if you are a long-term investor, of inclusion in EM.
But
so
still,
really
yeah.
you have a broad range of markets.
But still not adventurous enough to get back into China right now, Thomas?
No, I think China is structurally challenged by the property deleveraging. Yes, you have a tactical bounce, but that was coming. Remember, we were talking about the price earnings of Chinese stocks being lower than the price to books of NASDAQ. So, of course, valuation was so cheap that people get back in. You have a lot of short coverage coming on right now, so that is helping the market as well. But look, you have a property sector that is still impacting consumer confidence, and we see weak prospects, given that the growth is still helped by exports.
Yeah.
So stimulus is not there to be big enough to really be a catalyst for consumer spending.
Right, and some of the markets that you mentioned, you're overweight, and so Japan, Korea, Vietnam, maybe to a lesser extent. You mentioned the currencies is a boost to Japan, but I'm wondering how you're hedging currency risk right now. If you're a dollar investor, you look at some of these markets, and you're probably worried where the won is, where the yen is, for example, where the dong is trading, where the yuan is trading if you're long onshore markets in China. I'm wondering how you're looking at that.
So we are hedged on the Japanese yen, for example, and we started the year on more of a view of a weak US dollar, but we changed that view right now. So we can see that the US dollar is really supported by the interest rate differentials that is quite large and still expected to be meaningful. So growth is also quite reasonably resilient in the US. So you have interest rate differential, which is on positive US dollar, growth differential, positive US dollar.
Yep.
So that's why we are hedging external currency from a US-based investor.
You're still favoring value over growth, though, right
Yes.
now. Why so?
So because we are looking at a broadening of market leadership. Of course, the story last year was big into the Max 7, but we can see that value sector can benefit from the uptick in economic growth, and we are modestly overweight that sector.
What about the fixed income part of your portfolios? I know you're mostly overweight equity markets, but sort of within fixed income, even if the Fed cuts in December, it doesn't mean inflation can't hit your bond returns before December. Should I look at inflation protection? Should I go long duration? The opposite? What's the call?
So we agree with your point about inflation protection. That's something that we need to own in our portfolio, but we do that through the short part of the curve. Okay. So that will be more short-term tips. And then we are underweight duration still in the portfolio. We see the risk of yields moving higher. And with that, we are left with credit. We still see value in EM debt and also in high yield, where you can capture the carry. And in a low volatility environment, that's what you want to be.
And duration, how are you looking at that right now?
So duration, we are underweight. To be fair, that's perhaps in some of our portfolio our largest risk allocation, to be underweight bonds where we see yields moving higher until the end of the year.
Right. And for investors, and I guess it depends on what type of investor profile you're speaking with. People talk about fine, we're, let's say, 6 months from the Fed cutting rates at best. How do I look at all-in yields right now? Is it time to lock those in if I'm in this for the longer term?
I think if you are an investor that is looking at 2 to 3 years and you want to, you're happy with 5-6% that you can get in credit markets, you can build a buy and hold with very safe credit analysis. So that's definitely something that we see quite a number of investors doing in China and in Asia, where they are happy to just lock in the yields for now, and that's definitely something that I would recommend. So more short-term duration, credit to pick up an extra spread, and you can get about 5 to 6% depending on how aggressive you want to be.
So modest to overweight on equities over bonds. How should I be looking at other asset classes, commodities, even cash right now?
So
Bitcoin.
Cash remains still an asset class that you can own, given, as we said, 5%. You have an inverted yield curve, so it doesn't make sense to take too much duration there. On commodities, I think it's a bit of a mixed picture. We would be quite positive on sectors like copper, which is definitely benefiting from this infrastructure rebuild and new energy. But on the other hand, I think oil had quite a good run, and we might see some oversupply. We can see a build-up in inventories. So on the short term, maybe oil could be a bit more challenged near term.
All right, Thomas, great to have you here in Hong Kong. Thomas Poullaouec, their head of multi-asset solutions, APAC at T. Rowe Price. Taking some live pictures here right now. Take a look. First, we're going to talk a bit more on what's driving this bull market in China. We have a big discussion with our team as well from Bloomberg Opinion as well as BI. But take a look at this. These are live pictures that we're seeing when it comes to Modi's home state of Gujarat, where we're seeing he's headed to vote in this very heated Indian election campaign as well. We'll bring you the update next. This is Bloomberg. All right, watching some of the biggest decliners in the... Oh, live picks first. I'm sorry.
A bit grainy, though.
Yeah, there you go.
Oh,
there you see
more clarity now.
Prime Minister Modi there voting in his home state of Gujarat as we get ever closer to this very heated Indian election campaign. So certainly there he is, just about to cast his vote. I wonder who he's voting for, David.
Yeah. No line, too. Went straight to the front.
Of course.
It's early in the day.
Yeah.
Why not?
It's his home state, of course. I guess he gets dibs on everything.
Yeah. I'm guessing people know who he is.
Yeah.
Right?
Of course.
There we go. If they don't, he's in trouble with the elections. But, okay, that's another conversation. Let's have a look at what's happening across these markets. 45 minutes into the session here in Hong Kong, and some of the big decliners have been really some of the big winners of late, right? So Meituan was actually up 80% almost before today. And really, how far has its rally gone? So when you look at it from the bottom, which was late January, early Feb, and we put together a chart that tracks basically, not all, but all the major benchmarks here. It's really in favor of growth, in favor of Hong Kong listings. So we're up about 30% on the Hang Seng Tech Index. We're up by half on the CSI 300 and on the Shanghai Composite. But as you can see, it's done very, very well for many of these benchmarks from that bottom, of course, back in February. All right, so where do we go from here? Shuli Ren is with us here on set, our Bloomberg Opinion columnist, and also joining the conversation is Marvin Chen, our Bloomberg Intelligence equity strategist. Marvin, let's start with you. There's a lot of momentum in this market. Can it continue?
Yeah, we think some of the comments from the Politburo and the timing of the third plenum can kind of sustain this momentum going into the summer. And I think this focus on structural reform is something this rally has been missing so far. So if we think back to like February, we've been really rebounding off short-term measures such as short sell banning, market intervention, but the underlying economic problems such as the property sector still exist. So now markets have kind of stabilized. stabilized, and we're seeing more focus on the structural medium to long-term reforms. And I think the timing of the plenum fits into this narrative of stabilizing markets and then buying time for leadership to kind of focus on more structural reforms is something that markets are looking for.
Julie, your column today talks about the mood that's shifting here in Hong Kong. What do you think is driving it?
There are two fears that are driving investors repositioning. One is the fear of getting caught. Another fear is the fear of missing out. Getting caught in the sense that we all know coming to 2024, everyone loves Japan and hates China, and everyone is piling onto semiconductor stocks because of the AI rally, etc. Right? And then, like just 2 weeks ago, TSMC's earnings disappointed, and we realized the chip up cycle may not be as strong as investors had hoped. And the yen sliding past 160 means that the dollar-based investors, they're just not making as good returns. On the other hand, just like what Marvin was saying, China finally has the date for the plenum, which means that they seem to have a plan for its economic future. And people seem to think that the economic policy paralysis is over. And we all know China is very, very cheap. So people are just rebalancing and trying not to be so lopsided, basically.
Right. And, Marvin, that takes us into, I want to bring you back in because you're looking at the earnings season as well. And at some point, investors will look for earnings because the market's so cheap. I believe they're probably not there yet. What are you seeing as far as the earnings season goes?
So far, first quarter earnings have been tracking a slight contraction year over year. We do think this is somewhat of a base effect because, consumer sentiment was still pretty positive in the first quarter due to reopening. But overall, we do think we also are seeing some downward revisions, but we're less concerned about the downward revisions because we see that as consensus, which is still at 15% growth for this year, kind of moving towards our estimate of 10% this year. But overall, we do think GDP growth is going to kind of feed through to the earnings growth later this year. And we do see a potential for a Goldilocks scenario where improving China inflation helps drive margins and earnings this year, while easing inflation in the U.S. allows for the Fed to cut once or twice.
Okay, so how should investors be positioned right now? What are you looking at?
Well, the regulators have been highlighting shareholder returns, so we think that's exactly where investors should be focusing on. High dividend yield SOE sectors such as energy and utilities. The other form of shareholder return is buybacks, right? So here the China tech sector, Alibaba, Tencent come to mind. Even after the April rally, if we look at HS Tech versus like the NASDAQ 100 or the MAX 7, we're still trading at a 30 to 40% discount. And, there has been signs that China tech is back to business, so we do see some room for valuation convergence here.
Yeah, that story's actually not gotten a lot of attention. Tencent's actually led some of the buybacks here that have taken place.
Yeah, so Alibaba buybacks have actually been larger over the past couple of years. They've recently announced the expansion up until 2027, I believe. But yeah, both have been buying back very strong. And some of the newer e-commerce platforms are also announcing buybacks this year.
Shuli, when you look at, let's take it back, say 18 months, 2 years, the market in Hong Kong, sharp rallies, then sharp declines. What does it tell you about where we are?
I just think Hong Kong is a very funny place in that there are no dominant investor bases, right? Like there are Americans, the Europeans, mainland Chinese, and local investors. There's no single dominant force. And as a result, a lot of factors can affect Hong Kong's stock market, like a Fed rate hike, U.S.-China geopolitical tension, China's economy, even local investors, random rumors. And I just think it's amazing that the positioning has been so light, and there's hardly any good news. I mean, we all hope for good news, right? And then there's not much. It doesn't take much for Hong Kong to come into a bull market. It just shows that the people really have fled this market.
All right, Julie, great stuff. For Bloomberg Opinion columnist, also Marvin Chen from Bloomberg Intelligence joining us here for that roundtable. We got plenty more ahead. This is Bloomberg.
Right, so now the IBM CEO says its AI unit has booked more than $1 billion worth of business already, in fact, this year. We're barely into May. Arvind Krishna spoke to us at the Milken Institute Global Conference taking place in Beverly Hills about the regulatory landscape for AI and also the broader tech space.
I think every regulator is worried about three topics, not just safety and regulation. They're worried about innovation, they're worried about competition, and they're worried about safety and regulation. So when you take those three together, the AI Alliance and Open really come together to help you foment innovation. So I think that actually helps the regulators to think about what is going on here. While I'll caution, there will be some guardrails that are always put, but in my experience, open technologies have always been safer and more secure than closed technologies.
Is one of the risks that maybe you're obviating with your emphasis on open architecture that some of the, I'll call them big guys, get an advantage and really have an entrenched position?
Well, I'll use the concept of a walled garden. When you have a walled garden, have those areas and technologies been more innovative or less innovative? I'll assert the walled garden has always been less innovative. And so I think that it actually helps you create more competition. Does it avoid regulatory lock-in of a certain one or two players? Likely, but isn't that good for all of us?
Are you pro-regulation?
I am pro-regulation as long as it is light touch and allows innovation to happen. I absolutely would be pro-regulation. If regulation tries to reduce innovation, I think that's a problem.
What about the distinction between regulating the technology as opposed to regulating the uses? We had Sam Palmisano, somebody you know well, on, who said he thinks regulate the uses, don't regulate the technology, because that will impair innovation.
Always. How can you regulate the technology when you don't even know where the technology can go? 2 years ago, who had heard of a large language model? If we come out with our technique called Instruct Lab, 6 months ago, nobody had heard of that. There will be another one and another one and another one. So I think trying to regulate a technology implies that the regulator and the policy folks believe no more innovation can happen. I think that's a bad bet to make.
That was the IBM CEO Arvind Krishna speaking with Bloomberg's David Weston there at Milken. Some of the other stories that we're tracking for you today, Citigroup has shifted the work hours of some of its staff in Kuala Lumpur to align with those in the U.S. The move is part of efforts to ensure a smooth transition to a one-day settlement cycle. Citi has also created a task force that will solely focus on the process, also known as T+1. It joins dozens of other financial institutions preparing for that shift that comes into effect on May 28th. Nomura is targeting 20% revenue gains for its global markets unit over the next few years. The unit's head told Bloomberg they expect 25 to 30% growth in macro credit products and equities, with the rest coming from wealth management. The business has returned to profit after 3 years of losses that included a $3 billion hit from the Archegos scandal.
Right. We're looking at a couple of movers here. So rare earths are actually, and this is, there we go, to my right. We're looking at some gains there, 2 to 8.5%. Really, a price hike in the industry might be boosting the earnings outlook for some of these, so just watch it very closely today. We're looking also at some of the movers across the region, and speaking of an earnings outlook, fast retailing over in Japan is actually seeing substantial gains going into the lunch break, 3.5% April sales. I do have the company's statement here coming out and talking about that. And Uniqlo Japan. Sorry, I'm just looking for, there we go. Because we're coming off a unique look at rare earths. Uniqlo Japan is very strong. That's according to SMBC Nikko
Summer
analysts.
products are also selling well.
Is it already summer? It is quite warm in Tokyo,
yeah.
I heard. Plus you have the weekend.
That helps.
That shouldn't be any surprise there.
Yeah.
Unicharm, 1.4%. Nintendo is also seeing 2.6%. And, of course, ANZ out with earnings. Boosting the buyback, missing earnings. Plenty more ahead. This is Bloomberg.
11:29 a.m. in Tokyo. Japanese markets are heading to lunch break in just a minute or so, and looks like we're still seeing another day of gains here of north of 1% when it comes to the Nikkei 225, and we're watching dollar yen very closely. That weakness coming back around 154 levels here right now, so certainly watching very closely. We had Konda saying, look, we're not going to intervene if markets are orderly. So is that testing the resolve of some of these traders here this morning? Yields are taking up just 1 basis point in your JGB market here right now. In terms of the Asia dashboard and what we're looking at, we talked about 2-year highs when it comes to Asia Pacific stocks here. If you take a look at the Asia ex-Japan, we're about 1.5% or so away from hitting those 2023 highs. U.S. futures are flat here. The dollar is catching a slight bid here. But if you look at sector by sector, it looks like tech, it looks like energy, real estate is doing decently well here today. Where you're seeing a bit of more of a sell-off is the consumption space, the healthcare space as well. So certainly, there's a lot on tap. There's an RBA decision coming up. And some earnings, too.
Yeah, so on RBA, right, so yields have been pushing lower of late, might be down to the fact that treasuries have been doing well. We were looking at the Aussie dollar, in fact, earlier on, because it might be a chance that if they do strike a hawkish tone, the Aussie might actually top that high we had back in March. I think we have a chart of that, which we can show you later on. But it's a weird split, because hold mostly, there's 1 or 2 economists that actually think that they might actually sneak in a hike.
Yeah.
I believe if you look across G10, with the exception of BOJ, they probably might be the most hawkish.
Yes,
the RBA.
among the APAC region here right now. So are they going to still be able to squeeze one in? Is the big question here, of course. But, it really was the inflation picture and what we saw in the first quarter that really kind of delayed the prospect of these rate cuts for Australia. So, yeah, there's the kind of trend lines that we're seeing and how we basically broke above, I should say, that trend line when it comes to the currency here right now. So let's get a little bit more about what is expected. Of course, seems like most economists still think we could see those rates holding at a 12-year high when it announces that policy decision just a little bit later on from now. Our very own Swati Pandey, our economics reporter, joins us for more. Swati, what else are you looking out for today?
One of the key things that we will be watching out is the tone of the statement, especially the last paragraph, which has a little bit of guidance, which they had tweaked in the March statement to say we are not ruling anything in or out from further increases in interest rates cannot be ruled out. So they dropped any reference to further increases in interest rates in the March statement. So whether they bring that back or not is going to be really critical, especially because we had an increase in inflation. It was a stronger number for the first 3 months of 2024. And that really took markets off guard because it was worrying that the disinflation trend that we had seen over most of 2023 had kind of stalled.
Right, and that's so. I guess my question is: has the RBA, I guess in many ways, the narrative in Australia, has that gone almost independent? Because we've seen global, these rate cut bets getting pushed back. The Fed every day we talk about that, and I'm wondering how the conversation is ongoing in Australia, or might that depend actually, Swati, on that last paragraph that you mentioned out of that statement that's due in about an hour or so from now?
Yes, that is right. And in fact, after the March meeting, we have not heard from the RBA officials at all. So it's been a long hiatus. The RBA will also release its economic forecast, which comes out every quarter. So that will also give an indication of where they expect inflation to be. Current forecast implies inflation will not come back to the 2 to 3% target until the end of 2025. So if they are able to keep that, I think interest rates will have to remain around the current levels. However, if it looks like they will need to increase interest rates to ensure inflation is in the path of inflation is intact, they will probably talk tough and may signal further increases. So market pricing is for 35 to 40% chance of a rate hike by August. Economists are not predicting a rate hike, the first rate cut from November, but markets see the risk of a rate increase. So that is a possibility.
Yeah, tell us a little bit more about what we're seeing in terms of the inflation pressures. I mean, there's still some stickiness in some components like rents, insurance, for example. Do you think that's enough, Swati, to worry the RBA?
Look, when we saw the February forecast, inflation forecast, it showed inflation around 3% by December 2024 and around 3% by December 2025. And we thought, why is it taking a year for inflation to remain around that 3% level? And now when we look at the stickiness in rents, in insurance, education, and some of these services component, it looks like the RBA knew what it was doing when it drew that longer path for inflation to return to the 2 to 3% target. And I think if it looks like that is going to be the case if inflation continues to be high, but within sight of the target and around that 3% mark by end 2025, the RBA will not be too worried. Whereas if it looks like it's going to go up 3.5%, remains around where it is now, it's going to really worry them.
Right. Swati Pani there, of course, in Sydney for us, giving us a preview. In 2 hours' time, of course, is the RBA. And if you are on the Bloomberg, of course, you can turn to your terminal for more on this. So this actually comes online, I would guess, a bit later on. Gets busy, of course, as we approach that decision. TLIV go on your Bloomberg terminal.
Yeah, we also heard from the ANZ Group CEO Shane Elliott talking a little bit more about his view on the strength of the Australian economy. Take a listen.
Clearly, there is some stress on the economy. I mean, that's to be expected given the interest rate rises, cost of living pressures, etc. So the market is subdued, particularly here, in Australia and New Zealand, and we see that, with more customers struggling. Although the number of customers struggling is still, from a historic point of view, relatively low.
All right, Shane Elliott there, ANZ Group CEO, giving us his assessment of where we are in the economy. They just released, of course, earnings a few hours back, buyback, but a miss as far as the bottom line is concerned. Right, plenty more ahead. This is Bloomberg.
Careful.
Right, welcome back. So just over an hour into the cash market session here, so it's at least as far as now is concerned here. So we were up 10 straight days in Hang Seng. Looks like we are taking a much-needed break. In fact, we'll see. Okay, we have a few hours left, of course, in the session. It's been an hour still only. Onshore markets have been just coming off highs a little bit. As you can see, we're trading flat right now. Now, speaking of Hong Kong, let's get more on this criminal proceedings taking place here in the city against Segantii Capital Management. The hedge fund's founder, of course, Simon Sadler, and a former trader. Now, the firm has long played a vital role in helping Wall Street banks unload chunks of stock, dominating one of the, certainly, market's last old-school businesses. Our hedge fund reporter, Bay, who is with us here to talk us through this. Well, I guess for our viewers who might not be as familiar, who is Segantii? Let's start with that background.
Segantii is a firm that was founded in 2007 by a trader called Simon Sadler. Before founding the firm, he worked for firms including Dresner, HSBC, and Deutsche Bank. Unlike other Asia hedge funds who typically buy stocks and hold them for fundamental reasons, Segantii is more trading-oriented firms, particularly known for its willingness to participate on a large scale in equity capital markets deals. At the peak, it managed just about $6 billion in 2021. Now it oversees about $4.8 billion.
Okay, he was known as sort of the block trade king in this region. Can you just explain a little bit more about these block trades?
Block trades are actually, it's a a loosely defined idea involving somebody unlocking a large block of shares in listed companies, but in private transactions. It could be the company selling new shares. It could be a shareholder, corporate insider selling shares, or it could be a large institution. So the tricky thing about block trades is oftentimes, the price-sensitive information that's involved, how to safeguard that information.
Yeah, and usually it's obviously not a good thing, but how is information shared before a block trade? It's obviously problematic, and what is the SFC? What are regulators doing about it too?
Sure. oftentimes the banks involved, or even the banks anticipating a deal, would go to a certain group of investors trying to gauge their interest in the pending deal. And it could be a hypothetical deal at that point of time. Usually they are not allowed to share detailed deal information until that investor is taken across the wall, which means signing an official pledge not to act on the insider information. But oftentimes, even before you get to that point, they have to share certain information with hedge funds or other investors to entice them to participate in the deal and be taken across the wall. And that's where the danger lies, because oftentimes the regular participant in this market, like the banks, have a calendar of the lockups that are ending and who are the potential sellers. So the little information that the banks share can help them guess who is the selling shareholder, how many shares are going to be shared, and that's when they can actually act on that information. And the SFC is trying to tighten the so-called rules on market sounding by bringing this kind of information sharing on recorded channels and demanding that investment banks keep records of such information sharing.
We've talked about how this is quite a high-profile case here in Hong Kong. What do we know about the process involved? Is this going to be quite drawn out?
Yes. So the only other case that I can remember involving a non-corporate insider was the criminal conviction of a Morgan Stanley, former Morgan Stanley managing director many years ago. He was initially, the initial SFC announcement was in 2007. He was initially sentenced in 2009, as far as I remember. He finally, SFC won on appeal in 2012.
So it's going to take a while.
Yes.
All right, Bei, thank you so much. A great piece
you.
there from you and your team on just what's been going on and the overall culture of surrounding Segantii as well. Our Bloomberg hedge fund reporter, Bei Hu there. Of course, you get more on the Insider's Guide to the Money and people shaking out the finance hub in our new Hong Kong edition newsletter. That's out every Thursday. You can sign up through our website, bloomberg.com/newsletters. We got plenty more ahead. This is Bloomberg.
All right. You want to do this or me? Okay, I'll do it.
Go for it.
Why not? I'm going to get more TV than you. State Street CEO Ron O'Hanley here says the capital markets have been showing strong resilience, really, in weathering serious challenges in recent years, from wars to the actual pandemic. O'Hanley spoke to us at the Milken Institute Global Conference taking place in Beverly Hills.
Before talking about the future, let's just talk about the recent past. I mean, if you think about what the world has been through in terms of the challenges it's faced, and any kind of challenge in the real economy translates to the financial economy. So we've had a pandemic, a once-in-a-century kind of pandemic, and we've also had ground war break out in Europe. And if you think about how capital markets have actually adapted to that, how you've seen underlying economies repair themselves. And again, the capital markets are very much a function of what goes on in the real economy. And you've seen, I think, extraordinary resilience in the real economy relative to what any of us would have expected.
What do you think was behind that resilience?
Not to sound jingoistic, but I think a lot of it was the U.S. led the way in terms of certainly in the repair of supply chains. I mean, what we were talking about in the middle of 2020 was the potential for this going on for 4, 5, 6 years. And the rebalancing would take that long. And in fact, really led by U.S. corporations, but also just large corporations around the world. It was really led by large companies figuring this out and saying, what do we need to do here?
You know, it's interesting that you bring that up, Ron, because if you think about the pandemic, global companies are rethinking their supply chains, and that has led to a new kind of investable idea. Walk us through kind of the new investable ideas coming off of the pandemic and just a lot of things being different.
Well, let's just stick with supply chains for a moment. I think that maybe with globalization we went a little bit too far because supply chains became highly, highly optimized with very little built-in, if you will, slack, or for that matter, capacity for the unexpected. So what you're seeing now is really a much more resiliency being built in supply chains. Instead of having single source, it might be double source, triple source. You're seeing some activities being brought to back to countries, reshoring, and it's not so much those aren't political statements as much as they are, you know what, we really ought to have a little capacity in whatever country, here in the US, here in Germany, here in the UK. And then finally, you're seeing opportunities being created for other countries,
right,
where it may be that a country like China had it all or had a large portion of it, and China's not going to lose everything, but you're starting to see other countries in Southeast Asia. All of these represent investment ideas.
We're seeing a lot of more things shift into like South America, Latin America. One thing I want to ask you, we were all focused this weekend over the annual meeting out at Berkshire Hathaway and Warren Buffett. Warren saying Wall Street creating kind of a casino-like atmosphere. He's talked about this before for investors. Do you agree with that assessment, or how do you see it?
So I think there's a concern about market valuations, and it's really a concern about a relatively small number of companies that are seeing lots of valuation expansion driven by things like AI and the belief of AI. So a couple things I'd say about that. If you take the S&P 500 index, right, which is cap weighted and just equal weighted, you actually say it's actually not that overvalued. And by the way, there's opportunities in lots of other companies, right? You were talking about 7 companies in the S&P 500. So that would be point number one. Point number two, which I do think we do need to think about, I'm old enough to remember the advent of the internet. And if you think about the mid to the late...
Not that old, actually.
If you think about the mid to the late 90s, there was that same kind of excitement, same kind of exuberance around a few companies. The internet was going to change everything, and it was going to change everything right away. And then 1999 and 2000 came. And we could find ourselves in a situation like that again, because the hype of a technology oftentimes isn't met by the actual implementation of it. So if you ask me what do I believe, I think that artificial intelligence in all of its forms will be a fundamental game changer for many industries. Is it going to happen overnight, and is it going to kind of reflect the valuations that you're seeing in a few companies? Probably not.
And that was State Street CEO Ron O'Hanley speaking with her colleagues Carol Massar and Romaine Bostick there at the Milken conference as well. Some big news to tell you about. That's really, we're getting a little bit more updates here when it comes to Amazon. So this is about AWS, and they're spending a $9 billion investment expanding its cloud computing infrastructure in Singapore. So the outlay, it's going to be done over the next 4 years, as we're hearing, doubles Amazon Web Services investment in Singapore. And it's really how, as they try to accelerate the adoption of AI as well. We've seen AWS expand beyond just U.S. A lot of tech companies as well, Microsoft, Apple included, have been growing their presence in Southeast Asia as well. So there you go. Big investment heading into the Lion City.
They did. They had made that announcement just now. In fact, they're at their ASEAN summit in Singapore, where, by the way, they actually established their first data center in the region, region in the Asia Pacific. There we go, doubling down on the CapEx. And it really underscores the growth potential here of the sort of AI narrative, particularly in Southeast Asia.
Yeah. All right. Let's turn to your China brief right now. Look at what's making headlines in national newspapers and trending on social media. Chinese state media are still focused on President Xi's visit to France. Now, Xinhua quoting him saying that China does not have an overcapacity problem. He made those remarks at a trilat meeting with French President Emmanuel Macron and European Commission President Ursula von der Leyen. She later said that the EU is prepared to deploy all tools to defend its economies if China fails to offer fair access to its markets. Elsewhere, an editorial in the Global Times is focused on the strategic significance of ties with France. It says that they're at the forefront of China's relations with Western countries and have always focused on the long-term interests of both nations. The China Daily reports on the May Day holiday numbers as well, saying the travel boom highlights the country's economic vitality, with tourists flocking to popular domestic destinations such as Chongqing. Now, that province saw, get this, 5 million plus visitors over the holiday, an increase of 15% from last year. Smaller cities, including Yangzhou, Luoyang, also saw a rise in tourism. The Global Times quotes experts saying that this trend reflects increasing diversity of tourism destinations and structural changes in the travel market. So you're getting a lot of people going to these tier 1 cities still, but I think Tripp said this as well. They're opting for maybe cheaper options, maybe tier 2, tier 3. Maybe a little bit more,
off the beaten path, experience.
There's so much to explore in China.
Yeah, I saw a couple of my friends posting that fantastic travels in Yunnan, for example, right?
Yeah.
Where it's really more great weather, nature, I guess.
And cheaper.
To your point, right? So we did have some data coming through here on the trends. So we are getting anecdotal opinions on what the trends are looking like. Now, we have some numbers to actually back that up. Official numbers coming out of the Ministry of Culture and Tourism talking about how total trips are actually up 30%. This is compared to 2019 levels, I believe.
Yes.
Spending's up 14%, outbound and inbound trips. But as you can see, right, the discrepancy between you are getting a lot more growth in volume and not too much spending.
Yeah. So they're going there, but they're just not spending, as much.
Yeah.
But outbound and inbound seems to be strong. I think Tripp was saying, you look at these long-haul destinations like U.S., Australia, UK were popular. Hong Kong, Macau, Southeast Asia, Japan, South Korea, most popular when it comes to some of these short-distance trips as well. Middle East countries saw more than 300% surge in bookings, though. That was according to Tripp.
Yeah, Jane's son mentioned that.
Talks about a lot.
Yeah, I think the dropping of the visa restrictions really made that happen, and also like just the increased connectivity between the business community and markets too. Okay, speaking of markets, there we go. MSCI China on your screens. This is really a look across sector performance. Today, consumer discretionary and communication services down about 1.5%, which we should mention those two sectors have actually led this rally on the way up. So maybe some profit taking today. This is Bloomberg.